So what I'll be doing today, indeed, in the next 30 minutes is give an overview of BEFIT. And then specifically, indeed, the proposal for, let's say, a common corporate tax base in Europe. I'll talk it through, but before I begin, I just wanted to say, so let's paint the background of this proposal a little bit, and I'll go into more detail in the presentation itself. And also before I dive in, as Daniel mentioned, in case of questions, comments, be sure to raise your hand or use your microphone. Always feel free to intervene. But in any case, we will also have 15 minutes after the presentation to further discuss. So the background of this proposal, well, currently corporate income taxation in Europe is not harmonized. And what I mean by that is that legislation of EU member states, as it regards corporate income taxation, is left up to the sovereignty of the EU member states. It's the fiscal autonomy of the member states to determine their own corporate income tax rules. And that also means, given that we currently have 27 member states, that, as you may expect, there are some differences between corporate income tax systems in those 27 different EU member states. Sometimes those differences are relatively small, sometimes they are major differences. And the idea behind this proposal, it goes back quite some years actually, is to take away some of these differences in corporate income tax systems, and in that way facilitate cross-border trade, cross-border activity within Europe. So that's a little bit the background. What I will do first, and that is my next slide, I will briefly give an overview of the BEFIT proposal that was published in September of last year. It's a one-slide overview of what we're talking about. And then after that, I'll dive into more detail and, let's say, dissect this proposal a little bit. So first, in brief, I already mentioned the idea is to have a common EU corporate income tax base. The idea, therefore, is more precisely to have an EU rulebook, EU rules that determine what the corporate income tax base is for certain taxpayers in Europe. Once that tax base is determined in accordance with the EU rules, then the tax base of the different EU entities are aggregated into, let's say, a single tax base. So, for instance, a profit of a French company determined under the EU rules can then be offset against a loss made by a Dutch company under the EU rules. That is basically the idea of this BEFIT proposal. So an aggregation of EU profits into a single tax base under common EU rules. I'll get back to what that precisely means, and I'll get into some more details later on. But it's important to stress that as, let's say, the idea of this proposal, but also the scope a little bit. So what's the aim? Well, I already mentioned at the introduction, a large aim is to reduce administrative burdens, and that's administrative burdens at the side of the tax authorities, but also notably at the side of businesses, so cross-border businesses within Europe. So a removal of tax obstacles in order to create a more business-friendly environment in the EU. So a simpler system, less differences between tax systems in different EU member states, and therefore more cross-border trade and activity. That's the aim. The idea is that this should apply from the 1st of July 2028. Currently, of course, we're in 2024. So that gives us a little bit of time, let's say 4 years, it sounds like a good window of time to implement those rules, but as you can imagine, it might actually be quite a tight time frame. But I'll get back to that later on. The proposal is mandatory for large groups, and it's optional for smaller groups. Again, I'll get back to what that means. Some first observations on this, still in brief. If we look at this, if I look at this from a, let's say, EU perspective, what I already mentioned in the beginning, so up to now, corporate income taxation is not harmonized at an EU level. Up to now, the reaction of the EU in the field of corporate income taxation has been more, you could say, reactive. So think about the influence of fundamental freedoms on corporate income taxation. Think about the corporate income tax directives that we have seen so far. For instance, Parent Subsidiary Directive, Interest Royalty Directive, but also ATAD, the Anti-Tax Avoidance Directive. All of those directives, they do harmonize, let's say, part of corporate income tax, but the aim is not to harmonize the corporate income tax base as such. It's more taking away very specific distortions, facilitating the fight against tax avoidance in specific ways. So that was the past, you could say. It was more reactive, reacting to problems that we saw. This proposal, you could say, at least in my view, goes more in the direction of harmonizing corporate income tax. So it's a further going transfer of sovereignty, of autonomy of the member states to Europe if indeed the member states would agree to this proposal. So it's a change in how we approach, I think, corporate income taxation in Europe from a European perspective. A point that's connected to it and that I already mentioned, so it requires a additional transfer of sovereignty from the EU member states to the European Union. And when you think about it, actually, it's a quite significant transfer of sovereignty, I would say, because indeed, up to now, member states have been reluctant to transfer their sovereignty in the field of direct taxation to a far-going extent to the European Union. At the same time, so on the one hand, it's a quite significant transfer of sovereignty. It would be a quite significant transfer of sovereignty. At the same time, the proposal in its current state is less far-going than previous proposals. For instance, previous proposals included an allocation of the tax base among EU member states based on a formulary apportionment. The current proposal does not have such a formulary apportionment in it, at least not yet. Similarly, prior proposals included consolidation. The current proposal is an aggregation. I'll get back to the difference in that later on. Also, it's not a full harmonization. So it's harmonization of the corporate income tax base to a certain extent. Because as we will see, there are still a lot of opportunities for member states to choose and apply their own rules after the common EU tax base would have been applied. So quite far going, but also limited, you could say. More in-depth look, BEFIT. Let's have a further look at what is in it. So this builds on previous proposals, for instance, the common consolidated corporate tax base, and those proposals are withdrawn. And it also is meant to complement, I already mentioned, ATAD, but also Pillar 2, which you discussed earlier today. And also it's meant to fit with, let's say, what's on the outlook. So future directives such as UNSHEL, DEBRA, and also Pillar 1. I'll touch upon 5 aspects of BEFIT and have a look in a bit more detail. The first is the scope. So to which taxpayers does it apply? Then we'll have a look at the tax base computation. So it basically starts from annual accounts and then makes some limited specific tax adjustments to those annual accounts. We'll also have a look at the tax base allocation. I already mentioned the current proposal does not have formulary apportionment. It includes a transitional allocation rule for the time being. Then there's a transfer pricing risk assessment proposal in it, a little bit of transfer pricing. Dr. Yi Ayun will, of course, discuss the TP directive later on, but some of it is mentioned in BEFIT as well. And then finally, a little bit about administration. So let me start with the scope. I already mentioned it's mandatory for larger groups, and those large groups are groups that are also covered by Pillar 2. So the scope of taxpayers for which BEFIT would be mandatory is similar to Pillar 2. And that means groups with an annual combined global revenue of at least 750 million. And then the BEFIT group would, of course, I would say, only be limited to the EU subset of the entity. So companies and permanent establishments located in Europe, meeting a 75% ownership threshold. So the scope for the mandatory groups is quite similar to Pillar 2. And that's, of course, intentional to have a kind of a benefit of having this run next to Pillar 2, you could say. For groups headquartered in third countries, there's an additional, let's say, materiality threshold. I put it on the slide here. So also groups headquartered in third countries can form a BEFIT group for the European part under certain conditions. BEFIT is optional for smaller groups with a taxable presence in the EU, under the condition that they prepare consolidated financial statements. So it's hybrid in the sense, the scope is hybrid, mandatory for certain groups, Pillar 2, but also optional for other groups. There was also a consideration by the EU to have it mandatory for all groups or to have it optional for all groups. But they thought this would be the most, let's say, proportional way to go. It does mean, of course, that some groups will have to deal with this if it is agreed. For other groups, it's optional, so you can choose for it if it's beneficial for your group. And that of course already shows that we will still be working, if this will be agreed, we will still be working with also local corporate income tax systems for those groups, smaller groups, for which BEFIT is not mandatory, or for those groups that simply do not opt, the smaller groups that do not opt to use BEFIT. If you need to apply BEFIT, if it's mandatory for you, or if a group opts to apply BEFIT, that's in principle a 5-year commitment. For mandatory groups, that's automatically renewed if you still meet the conditions for mandatory application. For optional groups, it's an option after the 5 years to renew it, let's say, for another 5 years. So applying it for 5 years' time. Then I'll go to the tax-based computation, the next part. As I mentioned, the starting point is financial accounting. So think about generally accepted accounting principles, domestic GAAP, but also IFRS, for instance. And this is similar to Pillar 2, but it's not the same because adjustments here are kept to a minimum on purpose, and there are fewer adjustments here than under Pillar 2. So the calculations for the tax base, they look like Pillar 2, but they are slightly different. And that, of course, means if you think about the perspective of reducing administrative burdens, that actually, if BEFIT would be agreed upon as in the current state, actually there might be increased administrative burdens, at least in the short term, because it's again a separate calculation that is slightly different from Pillar 2. The adjustments to the financial accounting have some specific inclusions and exclusions, and I listed those on the slides. Now I will not go through all the inclusions and exclusions in detail, given the time, but I'll pick out a few that I would like to highlight just to give a couple of examples. Before we go to those inclusions and exclusions, it's good to say that, as I mentioned, we have a calculation of the tax base in each for each BEFIT group member. And then once we have done that calculation under the EU rules as proposed in BEFIT, afterwards, the next step is aggregating those tax results into a single pool. So that means, as I mentioned in the earlier example, the possibility of cross-border loss relief in Europe. So a loss incurred by a Dutch company would then be able to be offset against profits, for instance, of a company of the same group realized in France. So that's, of course, a big advantage for cross-border groups in Europe. And that is also, I think, one of the biggest benefits that BEFIT would bring. So partly harmonized corporate income tax base, but also certainly cross-border loss relief is a big point. Also, there will be no withholding tax on intra-BEFIT group transactions, for instance, royalty payments within the BEFIT group or interest payments. But that in itself in Europe is already not such a big deal anymore, I would say, with the interest royalty directive and also given the tax treaties in place. There are certain exceptions to the rule of aggregating the tax results and also allocating those tax results, those aggregated tax results to the EU member states involved. Those exceptions are specifically for extractive activities and also for certain shipping income. So that kind of income related to those activities is always allocated to the country in which those activities take place, you could say. So that's a bit of an exception to the general rule. Possibly in the future, this system might mean that there's no need for arm's length transfer pricing within the BEFIT group anymore. But as the system currently is under BEFIT, you do still need arm's length pricing intra BEFIT group. And I'll get back to that. So possibly in the future, no more transfer pricing within BEFIT, but right now, under the current proposal, you still need it. All right, some inclusions. So that means elements that if they have been taken out of the financial accounts, you actually have to include them again to come to the taxable result under the BEFIT calculation. For instance, there's a rule in BEFIT that's very much linked to a rule that's in ATAD. We call that an EBITDA, interest deduction limitation rule, which can limit the amount of interest deductibility for tax purposes. So you need to take that into account when calculating the tax base under BEFIT as well. It might mean that some of the interest payments are actually non-deductible. So specific inclusions. Other things are, for instance, fines, penalties, but also corporate taxes that you already paid. You basically have to add them back. Some exclusions as well. And the first point on the slide, a 95% exclusion of dividends and capital gains under certain conditions, is basically what we call a participation exemption. Now, in the Netherlands, we already have a participation exemption, and in most countries in Europe, I think, or in a lot of countries in Europe, we have a participation exemption. But for instance, in the Netherlands, currently, the participation exemption is a 100% exemption. So if we would have to apply BEFIT, that actually would mean that for the Netherlands, we would lose a little bit our current system of participation exemption, where you get 100% exemption, and we would mandatorily, for these groups covered by BEFIT, mandatorily have to tax 5% of the dividends and capital gains. So you could say that's actually a big deterioration for those groups. They are less well off than under the current system. And that might especially be the case because, as I mentioned, BEFIT is not a consolidation, it's an aggregation. And what that means is that currently in the Netherlands, it's possible, for instance, to form a fiscal unity for corporate income tax purposes. And that means that if you, for instance, have a dividend distribution from a Dutch subsidiary to a Dutch parent company within a fiscal unity, you do not recognize that dividend, you do not see it for Dutch tax purposes. So you do not need a participation exemption. The BEFIT proposal does not include such a consolidation system, a fiscal consolidation. So it might mean that if you have a dividend distribution from a Dutch company to a Dutch parent company, you actually have to recognize the dividend for the BEFIT tax base computation, and then you do not get a 100% exemption as we currently have in the Netherlands, but only a 95% exemption. So that is definitely something to take into account and might actually be, if that is indeed how it plays out, be very detrimental for large multinationals which have a lot of subsidiaries in different countries. Other exclusions are mentioned on the slide. In the interest of time, I think I will not have a further look at those. I think what I will do is go to the tax base allocation. So once we've determined the tax base, the computation, we need to allocate the tax base to the different member states involved so that those member states can tax their share, let's say, of the tax base. Under the old rules, as I mentioned, the proposal was to have a formulary apportionment. But under the current rules, that's not included. Under the current rules, the tax base is allocated based on the taxable result of a BEFIT group member in perspective to the total taxable result of the BEFIT group. And in order to determine that percentage, you look at the last 3 years. So that means that you look at the profitability of the companies right now, and that would determine how much of the tax base is allocated to those countries under BEFIT going forward. And that tax base allocation rule is what they call a transitionary rule that would apply for 7 years, so until June 2035. That also means, as I mentioned, that within the BEFIT group, you still need to apply transfer pricing, because otherwise groups could potentially use transfer pricing to inflate or deflate their taxable result and thereby influence the tax base allocation. Possibly in the future formulary apportionment, but that would need then to be agreed upon by the EU member states. All right. The next point to discuss is briefly the TP risk assessment. The TP risk assessment is a traffic light system, as they call it, for transactions, TP transactions with non-BEFIT group entities. This is a very specific category of entities with low risk, such as low risk distributors, but also contract manufacturers. This is very similar to what we know from the proposal of amount B under Pillar 1, and basically says that for these types of transactions with low risks, they will make it easier for companies to assess themselves whether they are at risk with their transfer pricing, and by doing so also make it possible to basically estimate whether the tax authorities will focus on your transactions or not. It's a small subset. It's good that it's there, but it's only a limited subset, I would say. The final point on BEFIT before I go to, let's say, wrap up points is administration. And this is an important point. So the BEFIT group would actually need to file multiple tax returns. They would need to file one all-encompassing information return. So that's for the whole BEFIT group. And that needs to be filed in the member state of the ultimate parent entity of the BEFIT group. So that includes the results, the BEFIT tax base, the allocation that we just discussed. That's one tax return, but it's of course in addition to the tax returns that we currently already know. And that also shows because after the BEFIT information return, the BEFIT group members still need to file also local individual tax returns in all the member states concerned. And that has to do with the fact that after the EU BEFIT tax base has been allocated to the member states, the local countries can still apply their own corporate income tax rules to a certain extent to reduce or increase the tax base specifically in that country. So BEFIT gives room for the member states to apply their own rules insofar that is not governed by BEFIT. And that's also what I mean by it's not full harmonization. You can still have individual rules in individual member states applying next to or on top of BEFIT. So 2 tax returns, and then there's a BEFIT group, a BEFIT team, they call it, which include tax administration, representatives of all the EU member states where the group operates. And that also gives the possibility of easier joint audits for tax purposes. So additional burden, I would say, from an administrative perspective. If I may take some time, Daniel, I had a quick glance at the time because I noticed it's already half past. Maybe I can take 5 more minutes to give some first reactions and then open the floor for discussion. Of course, Clive, also, if that is okay with you.
That's fine, Martin.
Okay, perfect. Yes, Martin.
Okay. So some reactions to BEFIT, and some of these I already mentioned, some reactions, some concerns. So again, the goal of BEFIT is to reduce compliance burdens, but as I mentioned, the compliance burdens, the calculations, they are not exactly the same as under Pillar 2. And also there's a need to file additional tax returns, so a BEFIT information return, but then also still local individual tax returns, where again, specific EU member state rules may apply. So in my view, there's actually a risk of additional compliance burdens for the companies involved, but also certainly for the member states, for the tax authorities, at least in the short run. And that also might mean that implementation in 2028, it might come too soon. Not only from the perspective of getting the rules ready, having the companies prepare for this, but also simply the tax authorities. I know that in the Netherlands, for instance, the tax authorities are struggling with systems and monitoring and those kind of things. And this is, of course, on top of everything we already apply currently. So I think, to be honest, that in the short term, BEFIT might actually give additional complication and also uncertainty to a certain extent. While of course the goal is to have a simpler tax system and more certainty. And we might achieve that with BEFIT in the long term, possibly, but I think in the short term, actually we will get a little bit, we would get a little bit more complication and uncertainty. I already mentioned that aggregation, as proposed currently in BEFIT, is not the same as consolidation. And consolidation was the proposal in the CCCTB. From the perspective of companies involved, consolidation would be a bigger step, and I think more welcome than the current system of aggregation as proposed in BEFIT. The BEFIT cross-border loss relief, so being able to offset losses and profits, might actually partially be nullified under Pillar 2. What I mean by that is, so BEFIT allows you to share profits and losses, and by doing so, reduce the tax that you pay in a country. So the tax that you pay in France might be reduced by a loss that you had in the Netherlands. But then, because of that loss utilization in France, because you pay less tax in France, you might potentially drop below the effective tax rate of 15% under Pillar 2 in France. And if that is the case, it might actually result in a top-up tax for the missing tax under Pillar 2. So potentially, the interaction between BEFIT and Pillar 2 raises some questions. The same goes with the interaction with double tax conventions. So allocating some of the tax burden, cross-border loss relief, it doesn't. That's not how the current system of double tax conventions work typically. So there might need to be some adjustments there as well. The same goes for dispute resolution. So what if member states do not agree with each other? What if the company wants to object? There are rules in BEFIT for that, but of course the future would need to show whether those rules are sufficient. And finally, and that's the bridge to the last slide that I have, some EU countries have voiced some hesitation, some concerns, for instance, the Netherlands, but also Finland. And that brings me to my next slide, because in order for BEFIT to be approved, EU member states will first have to discuss in the Council of the EU, but then as a next step, adoption would require unanimity. So all the EU member states would have to agree. The European Parliament has an advisory role in that process, but unanimity, of course, is quite a high bar, and especially because we've seen in the past that transferring sovereignty when it comes to corporate income taxation is something that the member states are a bit hesitant in. Reaching that unanimity in the specific proposal might be a challenge politically speaking. But then again, of course, in the past, we have seen developments such as ATAT, and at that time, we also would not have thought that possible. So who knows, it might still make it after all. But it will be a difficult political process, I think.